On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're well. That's another week behind us, and the month of February is now behind us for financial markets at least. So let's talk about everything that we saw go on and what we can look ahead to in the coming week. So, global share markets. The S&P 500 in the US had another tough week. It fell 0.4%, so not terrible, but down slightly and certainly weaker than many of those other markets out there. That came in the wake of further technology weakness and also a stronger than expected PPI report, Producer Price Index report. So the core PPI, and that excludes food and energy, that increased 0.8% in January. That was well ahead of forecast for 0.3%, and the market didn't like that when it came out on Friday. So when we woke up on Saturday morning, markets were a little bit shaky on the back of that report. Other markets fared much better when you look around the world. Last week, the UK market was up 2.1%, Europe was up 0.3%, and the Japanese share market was up 3.4%. Emerging market shares were up 2.8%, while the Aussie market added 1.3% for the week. It was a good week here too. The NZX 50 index here in New Zealand gained 3.1%, so that was a very strong week. And I think that came on the back of some solid earnings reports, some upbeat outlook statements, and further comfort from that Reserve Bank decision and statement the week before. So the local market had a good week. It was actually its biggest weekly rise since August last year, and that saw us finish the month of February up 2.2%. So that was the strongest monthly rise since September. And I posted a really interesting chart on LinkedIn, at least I thought it was interesting, about what all the major asset classes and markets did in February and some big winners and losers. So it definitely is worth taking a closer look at. If you're not on LinkedIn, but you're a Craig's client, you can find it on my week ahead report, which is obviously the written version of this podcast, has a few extra details, has some more numbers, charts, tables, and so forth. So if you want to take a look at that, jump on the website, log in, and you'll see that interesting graph. Anyway, back into it. US interest rates, what did they do last week? Continued to fall. The 10-year Treasury yield in the US fell below 4% for the first time since November. So that finished the week at 3.94%, and some of that nervousness out there did see investors move into conservative assets like Treasuries. Local interest rates, a little move. The New Zealand 5-year swap rate finished the week at 3.5%. A couple of the key releases that are worth talking about, and there wasn't too much to be honest. I think the only one I'll really touch on is local business confidence, because this was interesting for the New Zealand economy and thinking about that path of the OCR after the Reserve Bank the previous week. So what happened in February? Well, the ANZ did see sentiment soften a little bit, but it remained very strong. So headline confidence fell from 64.1 to 59.2. So it's still well above that long-term average, but it has come off the boil from that 30-year high of 73.6 that we saw back in December. Markets have really cheered the early signs of recovery, the falls in mortgage rates, but they have just come back down to earth after that euphoria from late last year. Own activity actually pushed up a little. That's good news. It rose from 51.6 to 52.6, while what they call reported past activity, which is a really good indicator of GDP, it remained high despite a big fall for the construction sector. So I think when we look ahead to the middle of March, which is when we'll get the next GDP report, and that will cover the December 2025 quarter, that is going to look good. and everything bodes well for that strength continuing into 2026. So this was good news all round, I think, this survey. We also were watching closely the inflation indicators, and while they did remain elevated, they came down a little bit. So the proportion of firms that are expecting to raise prices over the coming 3 months actually fell back a little bit. It's still high at about 53%, but at least it fell back a little bit. Wage growth expectations coming in at about 2.5%. So on the whole, we've seen a lift in confidence that suggests this year will be a much better one for the economy. And while the Reserve Bank will still be monitoring some of these inflation indicators, it'll be happy that they have come back a little bit. So that was the key release here in New Zealand, the ANZ Business Outlook survey. In terms of what to watch in the coming week, it will be a busy one stateside. We'll have the ISM Manufacturing and Services Indices. They're due this week in the US, and we will also have the jobs report on Friday. This will all come amidst elevated geopolitical risks in the Middle East as US military action against Iran starts to look increasingly likely. So the ISM Manufacturing Index will be out on Monday night in the US, and then its services counterpart will be out on Wednesday night in the US. Last month, January, these were pretty good. The manufacturing gauge actually jumped to 52.6. That was the first time it had been above 50 in a year, and that was the highest since August 2022, so very strong. New orders were up too. They were almost the highest in 4 years. The services ISM, unchanged, but it's been a lot stronger. So it's been above 50. 50 is your break-even level. It's been above 50 for, I think, 19 months in a row. So it's already been strong, but it was good to see the manufacturing gauge lift and come to the party as well. In terms of the jobs report, if we look back to January, we saw 130,000 new jobs created. That was the highest level in more than a year. And we saw the unemployment rate fall back slightly. It came back to 4.3%. So not too bad for this month. Markets are expecting the pace of monthly jobs growth to slow to just 60,000, while the unemployment rate is expected to remain unchanged at 4.3%. So still a little sluggish on the labour market front in the US. You're hearing people talk about the jobless recovery that we're seeing, and it will be really interesting to watch how this develops, because the labour market is a really important piece of the puzzle for the Federal Reserve and in terms of its policy decisions going forward, as well as the general economic outlook. So those are the things to watch in the US. The ISM manufacturing on Monday, ISM services on Wednesday, jobs report on Friday, and it'll be a day later here in New Zealand because of the time difference. Right, what do we got elsewhere out there? Retail sales and GDP, they're out in Europe, and on Wednesday afternoon we'll get a swag of monthly PMI releases, activity gauges out of China. The global reporting season, well, largely complete, although this week we will hear from a few interesting companies. You've got Target, you've got Adidas, you've got Broadcom, you've got Costco, I think you've got Rentokil, you've got Reckitt Benckiser, so still plenty to watch. Across the Tasman, it will be a busy one. The highlight will be December quarter GDP. That is out on Wednesday. This will be an important release for markets. After last week's hotter inflation figures, I think the monthly CPI indicator came in at about 3.8%, I think it was. Whatever it was much higher and much stronger than people were expecting. So now the odds for another cash rate hike in May are sitting at close to 80%. Remember, we saw the RBA earlier this year hike its cash rate because of those inflation pressures that have come back to haunt them. Well, people are now talking about another one or another 2 hikes over the months ahead. So I think everyone will be watching these GDP figures, because one reason for that hawkish stance from the RBA were the capacity pressures on the economy. So everyone will be watching these GDP figures, looking at what it tells us about supply and demand across the economy, and that will play into expectations for what the RBA does next. So that will be really interesting too. Here in New Zealand, the reporting season has wrapped up, so there's loads of information on our website if you want to go on there and look through all the company reports about who were the winners, who were the losers, who did good, who did bad. Haven't got time to do all that here and now, but on the whole, I thought it was pretty good. I was quite happy with what I saw across the local reporting season, but it's largely behind us, so it will be a quieter 5 days, at least on the corporate front. However, we will get building consents. We will get the results of the latest dairy auction. They are out early on Wednesday morning, and obviously the dairy sector has been going very well. Prices are up almost 20% in a global sense so far this year, and we have seen Fonterra bump up its payout forecast. So I think the midpoint now at $9.50, which is about 5% higher than what it was before. Had a midpoint of $9 before, so we've gone to $9 to $9.50. That still wouldn't be as high as last season, which was a little more than $10, but outside of last season, $9.50 would be the highest of all time. So not too bad an environment. We'll be watching on Wednesday morning to see where prices are going in the latest auction. We'll also get the building volumes report for the December 2025 quarter, and that is another GDP partial, so another piece of the puzzle. We've already got the retail sales, we'll get the building volumes, there'll be a couple of others to come, and then in the middle of March, we will get that GDP report for the December 2025 quarter, which we're all hoping and expecting to be a lot better than we've seen in recent times. So that is how the week is shaping up. Remember, the NRL starts today, Sunday. So later today, you get 2 games from Vegas. Then the Warriors play the Roosters next weekend. Round 1 is broken in 2. So keep an eye out for that. That is the sporting highlight of the week and of the next 30 odd weeks, to be honest. Right. Thanks for listening, team. Enjoy your week. We'll talk again soon.
For more insights, visit craigsip.com.